Very briefly, let me just go through what we actually have in our mind. I think when we actually wrote this piece of strategy, I think it's quite a volatile time. I think if you recall, I think for the past maybe 1 month during December, I think market is pretty volatile. I think even the sentiment also pretty weak. If you look at some statistic numbers, I think in the months of December, I think about 156 stocks actually registered more than 50% decline year to date, and about 350 stocks, I think back then, registered a decline between 20 to 50%. That was how bad it was during the December. But having said that, I think after such a I would say the strong sell down, we think value have emerged. Why we think so? If you look at some numbers here, okay, this is forward PER for the FBM 70 index, which I actually got it from Bloomberg. You can actually see very clearly, I think during the December month, you have a sharp drop in terms of the forward PER, and it's actually definitely trade way below the 2 standard deviation, below the mean. Same actually goes to FBM small cap index. So to me, I think this situation actually only implying oversold kind of a situation. But for CI, probably it's not, because you look at CI, even I think, or despite a decline of about 6%, in I think in the fourth quarter, but in terms of forward PER, they're still trading pretty near the 3-year average. So the signal actually quite mixed. I think the big cap like CI seems to be quite resilient, and even despite the decline, the value, probably I would not say it's really a very attractive compared with the small and mid cap. And therefore, I think in this quarter, we said probably what we want to look at is probably those stocks who have heavily bashed down, and those stocks, after we impute all the negative, be it you cut the numbers or you actually lower your target prices, and yet those stocks still give you potential upside with quite a decent, I would say, the risk, and probably those stocks are the stock we want to look at. And actually, we have that in our list, but I will share with you all later. And again, a bit of others' view is that I think normally first quarter are pretty strong. I think quite supportive. Also, I think fourth quarter also supposed to be so, but the December volatility last year, I think caught us by surprise. But I think nonetheless, I think first quarter, if you look at the historical for the past last few years, you can see most of the greens actually appear in the first quarter. And I think a lot of people also worry about maybe the 10-year cycle, probably they'll come into a bad cycle or so. But as far as we're concerned, if you look at the chart here, this is a quarterly chart. You can see since 1998, the uptrend has been, I would say, they're quite established quite well. Even though I think with the sell down during the last December, CI is still able to hold above the uptrend support line, and it's quite clear cut. So long 1,630 and maybe 1,006 holding there, I think at least also you will see a sideways market, if not a continuous uptrend. One thing to look at, I think if you look at 2008, there was a dip there. There was a time I think US rating was downgraded, and even despite such a major news flow, the so-called breakdown in the uptrend was very temporary, and very quickly I think CI actually back up to the uptrend again. And if that's the case, I think for now, if you think I mean the CI going to break the uptrend, you need I would say a more major news flow before you can actually break the uptrend. Now, what kind of major news flow you have? I think now everybody talk about the trade war, everything, but initially it seems to be quite harsh on the both sides, but now I think seems everything also can negotiate. Interest rate from the Fed side originally, quite hawkish, and now also turning slightly more on the dovish side. That's why this can be actually reflect by the weakening in the dollar. In terms of simulation, we actually simulate the potential path for the CI for the next 1 year. It seems that based on our simulation model, there's actually quite good potential for the CI to move back above the 1008, just purely based on the probability. Looks like there's quite a high chance to see that. And in terms of numbers also, I think surprisingly, the CI actually, the big cap, the growth number actually pretty strong based on our estimate. This FY18, the growth actually based on our estimate was about 0.7, but for FY19, actually it can actually touch as high as close to 7%. But of course, I think some of this number actually distorted by some one-off item, like let's say like Axiata, IH, because I think for FY18 there was some one-off, so the earning was weak, and therefore when normalized, you can see a big growth. But nonetheless, if you look at numbers, if we plug in the core number using a consensus, we could plug in. I think for FY18 also, at least we can see a 3% kind of growth. I think nothing to shout about, but at least it's decent. And also, I think my analysts also cut their target prices for some of the stocks, and therefore, actually, we also lower our index target from 1805 to now about 1775. At 1775, that actually implies about 16 times PE. I think that is quite a norm. Unless if you're more conservative, you want to apply a lower PE, definitely, I think that level will be lower. But at least if you look at this chart here, 16 times is basically just a 3-year average, so it's not something that is impossible. Sector-wise, recently, I think post-result, we just upgraded the aviation sector, mainly the upgrade from the Malaysia airports. Already, we have a outperform call in AirAsia. Gaming, needless saying, I think all the while, actually, we quite like the gaming sector. It's just, I think, Genting, somehow, I think the luck wasn't that good. I think quite a lot of bad news hit the stocks. That we already factor in most of the negatives inside our numbers, and still, I think, based on analysts, it looks like valuation is considered cheap in that sense. Power utilities, I think, is one of the more resilient sectors. I think to us, I think power utility probably is more of the evergreen kind of sectors to look at. The rest are mainly neutral in nature. The only few underweight sectors we have is building materials. I think we just downgraded it, mainly because of the reduction in the construction activities. Healthcare, I think that is mainly on the valuation from IH. Glove, I think if you recall, I think for the past few quarters, I think we are the very few houses who are actually concerned about the glove sectors. I think mainly coming from valuations. I think some of the glove stock actually traded about +2, or even I think way above the +1.5 standard deviation above the mean. And to us, I think with the potential weakening of US dollar, I think that valuation probably, I would say may not able to justify for the shorter term. So that's why we always caution investors from that perspective. But nonetheless, I think among the within the sector, we like Corsan Rubber. I think if you notice, if you look at our report, I think the only one outperform call within the sector is Corsan. Plaster packaging, also because of the cost pressure, if you look at our report also, you actually see quite a number of time we keep highlighting. I think the cost pressure is there. I think the margin was hit below utilization, all those things. I think the two stock actually probably doing better compared with their peers, actually Sintex and SLP. Those are the two, I would say, the stocks actually still having an outperform call despite the underweight call for the entire sector. Okay, in terms of stock picks, as I said, instead of looking at the traditional, like the outperform call we have, like Asia, Airport, Corsan, even I think utility like Packers and Kenanga, we take a slightly different approach this round. We just said, well, why not just focus on those stocks who have heavily bashed down? And after you short listed those stocks, and then we look at their numbers, we review the numbers, we review our target prices, and still offer good upside after such a substantial cut. And if you look at the risk rewards, still making sense. And those are the stocks we want to look at. And this is how we come up with our first list. These are about 20 stocks that we call it our stock watch list for the 2019. And actually from this list also we further try to shorten it, because some of the names probably you can actually see mainly coming from oil and gas and maybe the exporter, I think the E&E exporter. But again, I think for oil and gas, short-term wise, because of the volatility in the oil price, that may not actually act as a very good catalyst. So we probably want to take out some of the oil and gas stocks. And also I think because of the weakening in US dollar also, we think the exports, E&E counters probably, I think in the short run may not actually able to do well. These two sector itself, I think after you took out some of the stocks, and this is the final 10 stock we selected for this quarter. If you look at the names, I don't think they are actually any stranger to you all. I think those names are pretty, I would say, familiar. And I think as I said, I think the main focus or emphasis for these picks are mainly more on the valuation, because they have been beaten down. And as I said, I think we looking forward for the very short-term potential relating catalysts. Like for instance, Aeon, I think the coming quarter results should be very strong, because fourth quarter numbers normally accounted for about 40% of their entire year earnings. And I think first half of the year also they have some one-off losses coming from associate, which will not repeat. So numbers should actually improve from there. And I think recently also the Aeon also be included inside the Morgan Stanley Small Cap Index. So I think these factors I think can be a short-term catalyst, and coupled with the valuation, because it used to trade at quite a high 20 time PE, now it's actually low 20, I think about 21 times. So, and if based on our forecast, it's definitely below than 20 right now. So, so to us, I think value is definitely there. The same, I think, in the same category, probably you can see Padini. Also, same thing. I think at one point before the slowdown, we have an underperform call for them. After the sell down, I think we also see value based on the data we have. I think during the time we write, Padini only traded about less than 12 times FY19 PE. To me, I think also it's a very attractive level, because it used to trade at the high teens, about 17, 18 times. And if you look at the yield, also I think it's pretty decent from there. So ROE, again, I think if you notice the ROE column, Padini is one of the stock actually give you quite a high ROE, and therefore historically have been trading at quite a high PE. And with such a the rating so-called, I would think that the value is there. Another consumer stocks we have probably is a Power Root. I think this also is mainly more on the yield side. I think if you look at the yield back then, it's close to 6%. If you look at the numbers also, we expect the number to improve. And in fact, I think at less than 12 times PE for FY19, that is considered one of the cheapest F&B stocks. If you notice, I think recently F&B stocks being one of the most resilient so-called sectors, their PE are trading way higher. I think Nestle probably about 40 odd times. I think QL also about there, about 40 odd time. Others, I think probably about 20 odd time there. About. So with this kind of PE to us, it's definitely value for money. Others value play probably, I think OCK and PESA is more on the utility play. If you look at the OCK, I think for those who don't know them, basically they are doing more on the telco tower. They build the telco tower and then they lease it to the telco operator. And there actually they correct the rental. So first thing if this kind of model, first thing come into my mind is more on the gearing, because this is an infrastructure play. So gearing is definitely there, but I think at one time it's probably quite manageable. Also, I think OCK, I think off late numbers are there. It's just that I think share price keep on the rated. Probably I think it's because of the entire sector. If you look at the telecom, you look at the other telco, their valuation also being depressed. So I guess it's the entire industry-wide problem. Yes, I think there are talks that the OCK may actually see probably, I think, delisting from the Shara list, because I think their audited account probably, in terms of the debts, they cannot fulfill the Shara compliance. They may actually lost their Shara status in the coming review. But again, I think management indicated they actually already fixed up the debts to Shara, so they may actually go back into a Shara list in the coming in the next review. So I think if it's any sound down after the announcement of the new Shara list, I think probably it's time to look at them, because fundamentally they have nothing changed. It's just that the Shara status temporary, so-called, they lost the Shara status temporary only. And PESEC, I think for those who follow PESEC, this stock actually, they're mainly into, I think the power generation, I think the substations. Also, I think in the rail project, also they're doing some signaling project there. I think if you follow the Busan announcement, since I would say the fourth quarter last year, there have been announced a few contract flows, and I think that contract flow can easily last them for another 2 to 3 years. And 50% of their project mainly coming from Cambodia side, because Cambodia is still in the midst of developing. They need a lot of power generators. So they have no short of project coming from Cambodia side. Used to trade at quite a high teens PE, about 18 times. Now it's below 10 times to us. It's definitely one of the value stocks you want to look at. Bank-wise, I think we have two here. Probably, I think within the two, if you just look at it, probably you want to just pick BIMB instead of MBSB, simply because I think you look at the BIMB, ROE is definitely higher compared with MBSB. In terms of PE, also lower, and the yield also pretty decent. And if you look at the entire banking sector, as you know, I think that sector, the growth is quite moderate, and if you look at most of the banks' top line now, they are mainly driven by the Islamic banking growth. If that is the case, if that is the industry norm, why not we just look at the Islamic bank directly? And the PNB is definitely one of the only listed, I would say, apart from MBSB, is the Islamic bank on Bursa. And if the why at BIMB, I would say have been depressed lately was because I think the market concerned about potentially they need to raise equity capital and therefore dilution. But understand from our management, this is not the case. I think they are able to refinance the 1.3 billion sukuk via the normal debt product, and no need for the equity capital raising. And I think out of 1.3, they already I think redeemed $500 million. So they're only left 800 million to go. So once that issue settle, I would think that BNB probably is poised for re-rating. And in fact, if you look at the ROE, they are one of the highest after public bank. Of course, I think their ROE high was because of Takaful. Takaful are doing very well, one of their associate. Other than that, probably we have UEM Sunrise. I think property side, I think everybody know. I think property is a tough sector right now. News flow is not there to support. I think, in fact, you look at some of the big developer, most of their headlines, sales target have been revising down, and I think is quite tough to make a call for the property sectors. I think apart from their valuation, if you look at valuation, I think no doubt they are actually trading at the multi-year low in terms of price to book, in terms of discount to RNAV, everything, any parameter you use it, definitely at the multi-year low. Why we choose UEM Sunrise is because I think their coming quarter result, fourth quarter, you should see a contribution from the Australia project. That Australia project probably will bump their earnings significantly, and to make it become a single-digit PE company. And because of that, I think this is one of the catalysts we are looking at. Probably with that, you should see at least a short-term relating catalyst for them. In terms of construction, we have few. I think just now you look at the list, we have few. We have Kamunda, we have Kejaya Prospect, we have Muhiba, and we have WCT. Out of these four, why we picked WCT is because I think Kejaya, obviously, I think recently share price already hit our target price. Muhiba, some said no, they are 80% of earning actually coming from their associate. That is Cambodia Airport. So, some investors may not like it because they said your core earning is not there. You are actually coming up, your earning just backed by your associate. So, the investor may not actually keen. But from valuation point of view, to me, probably it's also good news because the airport trade at a much higher PE than the construction. But again, I think this is another separate argument. For Kamunda, I think we actually called it last quarter, and I think it actually rebounded from the low already. And I think there are actually signs that there may few projects the government may actually need to review again, and probably I think they have a role to play with. And for a big cap contractor with excellent track record, they only trade at 10 times. I think probably it's quite a good stock to look at. Right? But why we choose WCT is because I think there can be more catalysts coming from WCT side. If you look at the announcement, contract flow is there. I think the market agent concern, the main concern is their gearing. I think they have about one-time gearing. I think one of the highest within the construction sectors. But I think that gearing can be addressed by their field strategy. I think, if I'm not mistaken, the company is looking at the REIT structure. At first, I think they have some issue with the Aeon, I think Bukit Tinggi Aeon with the Aeon Corp. But now I understand that the issue has been settled. That's why I think the asset is ready to go for REIT. And with, let's say, the few assets, say like Aeon Bukit Tinggi, Paradigm PJ, Paradigm JB, if they can actually read it out, their gearing can reduce substantially. And that is one of the catalysts we are looking at. And if you look at their valuation, their 0.3 time book, I think that is really, I would say, the quite a low price to book valuation compared with the other contractor. Yeah. So this all in all, I think those stocks are the stocks we're looking at. And one thing in common, you can see heavily bashed down, value have emerged, and that is the theme for the entire first quarter. And of course, I think it's not limited to that. Any stocks, I think, especially the mid and small cap, as you know, I think that they are those stocks are the heavily bashed down one. You also can actually have a look at them. In terms of core, I think we are pretty neutral. During when we actually wrote the time, I think the CI actually traded, I think slightly close to, I think maybe 1680, 1690. About I think the time we said we'll turn more aggressive when the CI actually dipped below 1670. Why? It's because of this area here. If you notice, I think most of the time when the CI actually make a bottom, probably is when they actually below -1 or -2 standard deviation. So the time it was slightly near the mean, and anything below this level is 1670. 2 standard deviation is 1620. So between 1620 to 1670 to me is low risk buying level, and this is how we define our buying zone. And with that, I shall conclude my presentation. Before that, I think just a little bit on the market risk itself. What kind of risks we are looking at? I think definitely one of them is the oil. If you look at the oil price, that is the oil price. I think the immediate uptrend was broken. CPO, I think probably you should see a recovery very soon. I think, in fact, I think this can be an opportunity, I think, in terms of oil plantation stocks. My analyst actually looking at potential recovery in the CPO price by second quarter. So we keep that in our mind. If, let's say, we see a strong recovery in the CPO, we might actually upgrade our plantation sectors to overweight. Others risk probably is more on the valuation. If you look at the valuation for CI, it is actually trade at quite a high premium against the regional peers. Again, I think that actually echo what we actually see. As I said, I think despite such a decline, CI in terms of PER still trading very near to the 3-year average. So this one will make the foreigner probably not coming in a very big way. In fact, I think based on our model portfolio theory, if you're a foreigner, probably you will want to reduce Malaysia stock, because their suggestion from the MPT in terms of allocation actually have been declining. That actually explains why the recent net selling from the foreign side, probably. Okay, with that, I think that is what we have. Okay, final one, I think in terms of volume price indicator, I think we saw some improvement from the CI. I think good news. But for small and mid cap, nothing there, still downside. So it's pretty mixed, but I think at least should CI able to sustain, I think the other two will actually follow. Yes, thank you very much.
Thank you, Mr. Chan, for wonderful sharing. Mr. Chan, please remain on the stage. We want to proceed to the Q&A session. Just a minute. For those who would like to ask questions, you may go to www.slido.com and hashtag Kenanga, and you can post your question here. And Mr. Chan will pick 3 questions to answer. Okay. Just a moment.
Any question? How many questions we have here?
Just pick any.
Okay. Will Kenanga emerge as next major broadband player? Okay. That depends on license, whether they got the license or not. Very simple. Yes, I think they are in the midst of talking about to help to build a broadband. But again, I think it's more on licensing and more how the industry going. I think if you look at the new so-called the blueprint from the telco, it looks like eventually government or I think somebody or an SVP have to actually take all the broadband asset into one SVP. And the names, like I think telecom, they are just a player. You can have other players to do so. So that is the eventual development in the telco. So again, there can be just provide I think the asset initially, and then maybe to transfer or to sell the asset to one SPV later on. Together, I think with telecom also the same thing. In fact, I think I see this as a really catalyst for telecom. If let's say that happen, that is definitely good for telecom, because then telecom will become an asset-like company, but no timeline, and then this kind of catalyst can be quite a long view. Where the others? What's the impact of KLCI? Current downgrade by DBS and Nomura. Didn't see much impact, to be very frank. I think most of the points, I think we already know. I think talk about budget deficit, we already consider. Of course, I think that weaker fiscal numbers actually make us, I think, lose out to the neighboring country. I think they have, so especially like Thailand, they have still have a net surplus position. That's why the Thai bahts are actually much stronger compared with ringgit. Definitely, I think that can be that is the case for the moment, at least for the next few years. But don't forget, as I said, I think cyclical, that is the challenging side. But longer term, the structural change could lead us to another so-called the level playing field. So I would say it's a short-term pain, long-term gain kind of situation, which I think in my first slide I already have that title. What else? I think view on the tech sector. I think tech side, to be very frank, I think tech have been undergoing 27 consecutive month-on-month growth. I think that is one of the longest year-on-year growth pattern. And I think we are actually pretty cautious. Initially we thought, I think the upcycle probably is coming to the tail end. And if you look at some of the recent iPhone downgraded numbers, everything, I think tech definitely is actually probably, I think, at the tail end of the upcycle. In fact, I think probably can be early of the down cycle. I think the only, I would say the positive about the tech probably is more on the automotive side. I think at least automotive segment, they are, what they call it, they are a slightly longer term in terms of their, what they call it, the cycle. But I mean, if that's the case by right, like KSM, like D&O, that should actually benefit. But recently, if you look at the KSM, why the number actually down so much is because I think if I'm not mistaken, there is an underutilization kind of scenario. I think one of the new order not able to give in time, and therefore they underutilize their new capacity, and therefore you can see KSM, I think recently they see some pressure. Grouptronic mainly, I think, is in the iPhone segment. So Grouptronic smartphone segment probably is more pressure compared with others. What else we have? Malaysia semiconductor sector that involve, I think, futures.
Last question, Mr. Chan. Last question.
Okay, I'm just thinking about what I mean is it the entire semiconductor, as I said, I think so far, I think it's more dependent on the smartphone. I think mainly, I think we are in the smartphone segment. Some actually, as I said, is moving into the automotive side, but mainly it's used in the smartphone side. As I said, I think once Apple having a lower sales target, that actually has some impact to the smartphone segment. Yeah. So, and coupled with the weak dollar, I would say in the short term, probably you see some weakness and some pressure there.
Okay. So thank you, Mr. Chan, for wonderful